is just to recount the accounting cycle. We'll go through it, and that gets you prepped for intermediate. So before intermediate, you've learned the accounting cycle, especially in your first accounting classes. Hopefully, if you've taken cost or managerial, you've gone into it again. But what intermediate is going to do is we're going to take all the elements of accounting, which are part of the conceptual framework, and then we're going to look at each element. And we're going to look at the very specific rules that go along with it, the presentations, the disclosures, the options, because there's a lot of options in accounting. So that's what we're going to do through intermediate. Through all the intermediate classes, we're just going to start at the beginning and move through all the elements from, as you move through classes. But just to get you up to speed, we're going to go back over the accounting system itself and what we do. All right, so the system collects and processes data, and then we turn all that data into information in the form of financial statements and reports, and we do it in ratio analysis. We do it in lots of ways, right? So it's not a singular manner of disseminating information, but we do use all the information in the system. And if you take in managerial, you know that we put a lot more detail into the system than pops out on the public financial statements. That stuff's used internally to produce internal statements that are useful to the people in their jobs. So it helps you look at debt, sales, assets, cash, inflows and outflows. And cash flow statements are at the end of KESO, and which is the book. And cash flow statements, to me, are the singular most important financial statement there is. It tells you more about a company than everything else combined. So cash inflows and outflows are extremely important. Profits, product lines, dividend and stockholders, rates of return, all types of ratio analysis. So these are our basic terms. We have events, transactions, accounts, real accounts, which are permanent, nominal accounts, which close out. Nominal accounts tend to be the income statement. They close out at the end of the period, and they end up into the capital accounts. We have the ledger, the journal, the posting, our trial balance, our adjusting entries, our financial statements, and then we have the closing entries, and the closing entries is what shuts down all those nominal accounts. And if we remember, debits must equal credits. Accounting is fundamentally an algebraic equation. Assets equals liabilities plus capital. Debits equal credits. So assets are debits, liabilities and capital are credits. It's a set of self-balancing mathematical equations. An account shows the effect of transactions on a given asset, liability, equity, revenue, or expense account. Every entry has a two-sided effect, right? It has a debit and a credit. Now, it can be on one side of the balance sheet, but there's always a debit and a credit. We can debit one asset and credit another asset. That's what we do when we buy things, right? We debit equipment and we credit cash because we bought something. It's an increase of an asset and a reduction of an asset. So it's just that there must be a debit and a credit for all to balance out. The account shows the effects of transactions, and we refer to these as the T's, right? These are the T accounts. You put the debits and the credits, and whichever side is higher, we subtract it out, and that's the balance that we have in that account. And that's how we figure out the true balance of any account. So if the sum of the debit entries are greater than the sum of the credit entries, the account will have a debit balance. So in this case, we have 18,000 of debit and 3,000 of credit. So we have a 15,000 balance. That's a debit. If the sum of the credits are greater than the sum of the debits, it's the opposite, right? So here we have 10,000 and we have an 11,000 credit, so we have a 1,000 credit balance. Now, some accounts have normal debit balances and some accounts have normal credit balances, and this is important for us because, normal debit balance, especially when you audit, you look at accounts that have a normal debit balance, and the first thing you do is look at the credit column. See what credit's going into it, because anything that has a normal debit balance, you'd want to know, like accounts receivable. Why would you credit accounts receivable? I'd want to know. It's the same on the other way. If it's a normal credit account, like an expense account, a debit in that account would like flip your mind. Why are you debiting? We don't do that. We avoid doing that. When balances flip, if accounts payable go negative or accounts receivable go negative, it's an indication of bad accounting, one thing. But there can also be other issues in other accounts when they flip over cash. If cash flips to a negative, we now have a borrowing, right? That's a problem. So we always need to know the natural or normal balance of any account. So the normal balance for assets and expenses are debits. So if an asset goes up, it's a debit. If an asset goes down, it's a credit. Liabilities, equity, and revenue are all normal balance credit. Okay? So it's assets and expenses that we debit, and the other three that we credit when they increase. So here's our accounting equation. Assets equals liabilities plus stockholders' equity. Assets have a normal debit balance. Liabilities are credit. We add common stock, retained earnings, subtract dividends, add revenues, subtract expenses. And that's one of the ways that you know it's a normal debit balance, because we subtract it out of the stockholders' equity. It's a reduction in stockholders' equity. Remember that income in and of itself, let me go back. No. Income in and of itself is a subsection of the stockholders' equity, right? Because they're nominal, they're not permanent. If an owner invests $40,000 in exchange for common stock, his cash goes up and his stockholders' equity goes up. Debit, credit. If he disperses $600 for wages, his assets go down and his expenses go up. Remember, expenses are a normal debit balance. Purchase an office equipment priced at $5,200, giving a 10% promissory note in exchange. Well, we got an asset of $5,200 and our liabilities went up by $5,200. Received $4,000 cash for services. We got $4,000 in assets, and equity goes up by $4,000 also. Pay off a short-term liability of $7,000. The asset goes down by $7,000. Liabilities go down by $7,000. Debit, credit. Declared a cash dividend of $5,000. Our liabilities go up by $5,000, and our stockholders' equity goes down. When we declare it, we're not paying it. When we pay it, we use cash. Convert a long-term liability of $80,000 into common stock. Well, now we're going to take our liabilities and reduce them. We're going to increase our stockholders' equity. Pay cash of $16,000 for a delivery van. Our assets, our cash is going to go down, but our asset, the van, is going to go up. But the important thing is that the equation remains the same, okay? No matter what we do, the debits equal the credits. That's what's very important. So with proprietors, we have capital and drawing. With corporations, we have a lot more accounts to deal with, right? And finally, our balance sheet shows common stock, retained earnings, net income goes into there, dividends goes into retained earnings. The statement of retained earnings is a substatement of the balance sheet. And here's our complete accounting cycle. We have transactions, we journalize, we post, we get a trial balance, we adjust them. We get an adjusted trial balance. We prepare our statements, we close, we get a post-closing trial balance, then we have the reversing entries. The reversing entries are the adjustment entries that we make to make up for time. Usually it's like accrued interest, things like that. We reverse them because when the actual transaction happens that we get paid our interest, we'll do a full transaction. So what to record? We have external, between the entity and its environment, and internal, that things that happen within us. And you remember the journal, right? Chronological record of transactions. So we invested $15,000 in cash in the corporation. We purchased computer equipment for $7,000. So in reality, the first thing that we all do is journalize something. The most difficult concepts we journalize. That's what we do. The parts that you know help you fill in the entire entry. Whenever you do a journal entry, the first thing you do is there an effect on cash? Because the effect on cash is obvious. It's one of the most obvious. So here we have invested $15,000 in cash in the corporation in exchange for shares of stock. So the corporation got cash and gave stock. So we debit cash. We know we increased cash, and then we got common stock of $15,000. And so we have our balanced entry. We purchased a computer for $7,000 in cash. Well, if we purchased something for cash, we spent cash, cash went out. That's the credit. So what was the debit? We got computer equipment. See, so always you have to figure out what the effect is on the accounts. You to figure out what accounts it is and what the effect is. But the first question that we always ask is there an effect on cash? Is there an effect on capital? These two are very important, and they will drive the rest of the entry. When we move from the journal to the ledger, we're moving one side of the entry, right? Okay, only one side to each ledger account, because one entry affects more than one account. So we have the cash, and we're going to move that to the cash account, right? So there's our cash account. We put our entry in there. So now our cash account has $15,000 in it. And the other one is common stock. And now our common stock has $15,000 credit in it. But only one side of the entry goes into the ledger itself, because the ledgers add up to a trial balance that gives us our balancing accounts. So if we look at our entries, right, here's we invest $100,000. Then we buy office equipment with a note. So our equipment goes up, our notes payable goes up. We receive $12,000 in cash from a client, and it's unearned. So we're going to have unearned service revenue. We pay $9,000 in rent. So $9,000 is going to go out. We have $9,000 in rent coming in. We paid advertising for $6,000. That will expire next year. So that's prepaid. It should be Pioneer pays. Oh, for insurance. So prepaid insurance of $6,000, and we paid out in cash. So our cash went down. Our prepaid goes up. We purchase for $25,000 3 months of advertising materials. So we got $25,000 worth of supplies, and we purchased them on accounts, so our accounts payable increases. That's a debit. We sign a contract. We'll start work in November. Payment of $7,000 is due following the delivery of them. So nothing happened yet. We just signed the contract. We pay $5,000 cash dividends. So if we paid it, it came out of cash, and dividends went up. Employees are paid every 4 weeks. The payroll is $2,000 per day. The payroll period ended on Friday, October 26th, with salary and wages of $40,000 being paid. So we're going to pay out $40,000. Our cash is going to go out by $40,000, but our expense is going to go up by $40,000. We received $28,000 in cash and bills Copa Company $72,000 for advertising services of the $100,000 performed. So we got $28,000 in cash. And we billed them for the rest of $72,000. And so we have revenue of $100,000. So we increased our 2 assets and we increased our revenue. So when you get it all, you take all those T accounts, they add into a trial balance, which balances. All right, that's what's important to know, is that they all balance. And then at the end of the period, we adjust. We adjust for prepaids, we adjust for unearned, we accrue revenue, and we accrue expenses. We're bringing what is basically a cash basis to an accrual basis. So we have to adjust the accounts that need to be accrued. So deferrals are either prepaid expenses or unearned revenues, okay? And basically prepaid expenses, we have to look at it and see how much of the expense we've used and how much is left to be used. And it's the same with unearned revenue. How much do we earn and how much is left to be earned? And once we figure out that amount, we move the amounts in or out based upon it, normally out when we talk about deferrals. We move it out into an actual account. So if we used up a prepaid, it moves to the expense account. If we earned a revenue, it moves to the revenue account. So it's basically cash paid before the expense happened, all right? And prepaids occur in a bunch of areas. Now, a lot of them we never really have to adjust because we pay rent at the beginning of the month, and at the end of the month, it's all used up. But insurance, supplies, advertising, things like that, we have to. And so whenever we do a journal entry like that, we debit and we credit cash, right? And as we use up the supplies at the end, in this one, it says we have 10,000 at the end. That's our in the account. So we need to make supplies expense 10,000. How do we do that? Well, we had 25,000. It needs to be 10. We need to take 15,000 out. So we move 15,000 to expense, and supplies becomes 10,000. It's about adjusting the account. So you need to know whether it's normally a debit or a credit, and you need to know the opposing account in order to fix it. And so you adjust them on this statement. I know I'm flying through slides because we don't need all these slides. I have a lot of slides. I don't want to go through them all. There we go, unearned. So unearned revenue is much the same. Unearned revenue is someone paid us in advance, okay? And so we have the money on hand, but we didn't earn it, so we put it in an unearned revenue account. So if we receive money in advance, we obviously put it in the bank, yeah, we debit our cash, and we credit the unearned account because we didn't earn it yet, right? So it can't go into revenue because it's not ours yet, revenue recognition principle, which we're discussing this week. And so at the end of the period, we take a look at what we've earned and what we still have unearned. And at this point, it says that we earned 4,000 of the services. Well, that's simple. If we earned 4,000, we're going to throw 4,000 into the revenue, and we're going to move it out of the unearned. So we're going to credit our revenue because revenue increases our credits. We're going to debit our unearned to reduce it. So now we have 8,000 of unearned left. And unearned is a liability because we owe it back. We owe something on it. So for accruals, we have revenues and expenses. We perform services worth 2,000 that were not billed. Usually at the end of the month, we either are in process or haven't finished or we haven't done it. So we bill. And when we bill, we debit accounts receivable, we credit revenue. So our accounts receivable go up and our revenue goes up for the part that we've performed. All right, and it goes into there and it goes into revenue. Expenses are basically the other side of it, right? A lot of it is like interest expense. So we have a 3-month note payable in the amount of 50,000. The note requires annual interest of 12% percent, three factors determine the amount of interest: the face of the note, the annual rate, and the time and terms of the year. So 1 month's worth of interest is $500. So to accrue that so that it represents properly that we owe that for this month, we debit interest expense because it's an expense, and we credit interest payable because we're going to owe that interest at the end of the period. And see, it goes into the expense column and it goes into the payables. It's the same with every other type. We accrue salary and wages at the end of the month because it's incredibly rare that a pay date aligns with the end of the month. And so we have to accrue everything: payroll, taxes, everything to the date. And so we debit the expense and we credit the payable. These are ones that we tend to reverse right afterwards because, when we make the actual payment, we'll debit the expense. It depends on the company. Sometimes they will just hold it there and reverse it when the actual happens, or they automatically reverse so that there's no errors made. It depends on the company. So here's salaries as of November 23rd. You have salaries and wages payable, salary and wage expense, and cash. So in this case, we don't reverse it. What happens is when we paid the wages, we remove the payable account. Those are the two ways of dealing it. So I think we've gotten where I want to be with you guys. And then you have your financial statements, right? So you have your adjusted trial balance, and it moves into the financial statement. The adjusted trial balance, the bottom half is generally the revenue and the income statement, and the top half is the balance sheet. Accounts are numbered in a particular order to make them sit that way, but it's always most liquid to least liquid on the balance sheet, and then we go from revenue through expenses. And then we have the retained earnings statement, which is the sub-statement, right, of the balance sheet. It takes the income statement and moves it into the capital account so that we can actually do a proper balance sheet. And it also helps us tick and tie our retained earnings to make sure it's correct. And closing entries, very important. Okay, first thing we do is close out any dividends. So we take the retained earnings and we close the dividends out to that because that's where it's coming from. Then we close the income statement. Okay, we take and we reverse to zero all accounts. That's what we're doing. Okay, we're taking every account and making it zero. So since service revenue is a credit, we're going to debit it. And then we're going to credit all of our expense accounts, which are debits. We credit all of them. The difference goes to retained earnings. Whether it's a gain or a loss doesn't make a difference. Whether it's a debit or a credit doesn't make a difference. It goes to retained earnings. In this case, it's a credit, which means it would be income. So now we've closed out all the nominal accounts, and we're left with the post-closing trial balance, which will only be balance sheet accounts. And we start over again. So we enter our transactions, we post from the journals, we do an unadjusted trial balance, then we adjust them. Then we take a trial balance after adjusting, we make sure it's all perfect, we look at it, we make sure it all balances. We pair our financial statements from that. Then we close them out. When we take a post-closing trial balance, we make sure that there are no nominal accounts still open. And then we prepare reversing entries if we're going to. Some do, some don't. All right? So that is a quick review of the accounting cycle for you, just to bring you back to where you should be to get ready for this class. All right, everyone?